Our small business topic today, venture capital fund performance. When will it turn? Joining us now with his thoughts, Dan Primack, editor of PEHub.com. There's been a significant decline in 10-year returns for the VC market. The National Venture Capital Association says without a stronger IPO market with multiples of 8 to 10 times the current volume, these longer-term performance numbers will continue to deteriorate over the next few years. So, Dan, that said, is the IPO market likely to experience a tenfold rebound in the near future?
Well, it depends on what quarter. If it's based on a couple quarters ago, maybe, because there was 0 IPOs, so 8 or 10 times 0 would still be 0. Look, there's going to be a rebound. You're already starting. You've seen a bunch of filings, more on the private equity-backed side than on the VC side. You're seeing an increase, but 8 to 10, so talking kind of 20, 30 IPOs a quarter, I don't see any indication yet that that's anywhere in the foreseeable future.
What about the downside? How much worse is it going to get for VCs?
For VCs, it's going to become disastrous come January 1st, just from a kind of long-term performance standpoint. Remember, 1999 was kind of the last year of the real internet boom when it came to companies just being able to go public really quick, get massive valuations, which means that come 2010, those 1999 results fall off the 10-year returns, which are things that the venture capitalists and the venture capital trade groups point to constantly as we've got great long-term returns, see how we've done over 10 years. What it's going to mean is that probably the median venture capital fund over the past decade has actually lost money, meaning if you were a pension fund or an endowment, you would have been better putting your money under a mattress.
Why was 1999 such a great year for VCs?
Really because you had the IPO market just going gangbusters. You had situations where venture capitalists would fund a company in January and the thing was going public in September. It sounds ridiculous, but it's exactly what was happening. So a lot of VCs were able to sell a bunch of shares in those companies, make great returns. There was also a good M&A market at the time too for similar reasons. But then came the dot-com bust and it all really fell apart for them, which means that funds going back to 2000 are a bit disastrous. I will say one VC person said to me the other day that maybe what venture capitalists have to do is start looking at 12-year returns and forget about 10-year returns.
How will the dip affect VC firms going forward, and also will it affect startups seeking VC money?
It's going to affect VC firms in the sense of it's going to continue to be harder and harder to get new fund capital. And because you've got institutional investors who already have some liquidity crunches, and they've got to make decisions on what asset classes to invest in. And they're probably not going to change their overall alternatives allocation, but within the alternatives allocation, venture capital is a small piece of it, and it could theoretically get even smaller if the institutions decide that venture capital as an asset class is not a good place to put your money. And that obviously trickles down to entrepreneurs. Less fundraising, less available cash for them.
And even with the decline in the 10-year returns, overall the venture capital index significantly outperformed the Dow Jones and other major market indices over the past year, as well as the past 3, 5, and 10-year time periods. So will the with the general public absorbing huge losses to their stock portfolios over the past year, do you think venture capital is a safer long-term bet for investors at this point?
No, it's not. It's safer, no. It is if you can get in that top decile or maybe top quartile of funds. But if you're in that bottom 75%, it's a really, really bad place to be. I think as most venture capitalists and limited partners will attest to, it's just all the venture capitalists insist they're in the top quartile and all the limited partners insist they only invest in the top quartile. The rest of it's tough. I wouldn't pay too much attention to one-year numbers. There's a so-called J-curve, which basically means one-year numbers or even 3-year numbers for venture aren't all that important. Usually they're artificially low. But still, the long-term numbers in venture aren't very good, and you have to remember that you have to remove fees from those also, that the investors are paying an annual fee, and also a percentage of that profit's getting removed also before the investors actually get to put the money in their own accounts.
Okay, our thanks to Dan Primack, editor of PEHub.com. This is Reuters.